Even in the world of enterprise, there is stratification. What is the revenue of the business? How many people do you employ? All banks talk about loving small business until the small business needs love. If you're not laughing, you're the banker we're talking about. If you want to understand banks, you need to understand credit and risk. Everybody else in the bank, that's makeup. All of them eventually get to whomever it is that calls the shots, and it's always credit and risk. The bank's not lending to me because it's the devil. No, it's credit. Can I get a sense in the room how many of us here run our own businesses? Okay, good. So I want to start first with the image that you see on screen. Over the years, one of the things, just by grace, that I've been privileged to learn and understand is that even in the world of enterprise, there is stratification. Now, most of us, I imagine, understand stratification of businesses insofar as it relates to the quantitative measures of a business. This is why we talk about things like SMEs or MSMEs, micro, small, and medium-sized businesses. We tend to bundle organizations into those kind of stratifications, those layers, those models and frameworks of differentiation. Hey, Lucy. Those models and frameworks of differentiation, we tend to do that typically looking at quantitative measures. What is the revenue of the business? How many people do you employ? These are measures that make sense. I imagine for those of us here that work in banks, in fact, let me restate that. I know for any of you here that work in banks that this is how banks do stratification of clients. So they've got a micro business portfolio, typically with junior people, very low touch, low frequency. Then they've got a small business portfolio, and it doesn't matter where in the world you go, all banks talk about loving small business until the small business needs love. You know, that's true. If you're not laughing, you're the banker we're talking about. I have a view and a theory, by the way. I think that if you want to understand banks, you need to understand credit and risk. That's a bank. A bank is credit and risk. Everybody else in the bank, that's makeup. Marketing, sales, branches, distribution, even the IT people building those beautiful apps. That's all makeup. But the bacon in the bank is credit and risk. Because that's the team that allocates capital to whom and prices it. And so when you hear small businesses say banks don't give money, I can tell you, the marketing team can tell you whatever they want to tell you. The sales team will tell you whatever they want to tell you. If you've done well, you've got a private banker, they will tell you whatever they want to tell you. But all of them eventually get to whomever it is that calls the shots, and it's always credit and risk. So a little bit of homework. If you're in the room and you're an entrepreneur, you can literally go online and find courses to learn about how credit in banks work. You can go online and find a course on Udemy. Actually, I did one a few months ago to understand how credit and risk in banks work. Changed my entire perspective. Understanding how banks price risk, how they understand risk, how banks report their earnings. Once you understand this, knowing the science often removes what we like to believe is issues of like spirituality. You know, the bank's not lending me to me because it's the devil. No, it's credit. Go back now to talk about these stratifications. And so you have these small parts of the bank, typically where they focus on small business. Then you will also have where they talk about medium-sized businesses. It depends by country where you are. In South Africa, to be a medium-sized business is circa 250 million rand top line. That's as near as makes no difference, about $20 million, depending on the exchange rate. At a $20 million business, you're a medium-sized business. And what does that mean? It still doesn't mean you get to bank with corporate and investment banking. You won't get any complex structures for any of the things you're doing. They'll have a number of vanilla products that they will tailor for you. So they'll do things like they'll have a derivatives desk or a bonds desk, or they'll have a customs business. They'll have an import-export business with a number of vanilla products that you can use. Some of you here who are in the import-export business know what it is I'm talking about. We do a lot of Forex, so we understand what that business is. Great vanilla businesses, and within the vanilla framework, they will allow you to buy a product at a particular price point. And you got to remember, the bank is the casino. The house never loses money. All of these, to make my point, are quantitative measures of a business. When I travel to beautiful countries like yours and I talk to entrepreneurs, if you ask an entrepreneur, how well are you doing? Typically they answer you by telling you how many people they employ. That's a emerging markets thing. You see it usually in Africa and the Asia Pacific regions. We think the more people you employ, the more successful you are. I think the more people you employ, the more bloated your payroll. I think if you really want to understand the value of a business, there are separate measures you want to look at. It's not excluding employment, but to be clear, it's a business. It's not a government department. So how many people you employ should be an output, not an input. Quantitative measures. Quantitative measures are always functions of outputs, not inputs. They lag, not lead indicators. Ten years ago now, I was invited onto South Africa's version of Dragon's Den. And from that experience, I learned a few things. But one of the things that sparked my interest during the whole season of the number of investments I'd made, I started watching the entrepreneurs that succeeded and the entrepreneurs that did not. I wanted to understand, what is it that made the difference between those that succeed and those that do not? Is it race? Is it gender? Is it background? Is it education? Does it follow that if you are a young black female with a master's education, you will be more successful than if you are not? I asked this question for the following point, because I recognized that there were pots of capital aimed at a particular class of persons. This is not a statement about why that pot of capital exists. It is a statement about whether or not that classification is an indication of your propensity to success. Does it follow that if I am a young black male or a young white male between the ages of 18 and 25 with a honors level qualification in mathematics, I will therefore necessarily be more successful at business? I'm a numbers guy. So I spend my time looking at the numbers to understand patterns. And I couldn't find the pattern. There was no pattern between race and success. I couldn't find a pattern between class and success. Couldn't find a pattern between education and success. Couldn't find a pattern between gender and success. In my world, the world I live in, it's the world of complex problem solving by looking at the universality of rules. So the expression is that we try to simplify the problem without making the problem simplistic. It's a complex problem, simplify it without using simplistic thinking. Any of you here who studied economics, you do this all the time, you're trained to do it. It's the first rule you learn in economics, Ecos 101. Ceteris paribus. Hold all else equal. Why? Because for the study of economics to work, for a supply and demand curve to work, you've got to make the assumption that certain constraints remain fixed so you can analyze the constraints that are variable. In the real world, none of those constraints are fixed. All of them are variable. But you can't analyze a complex problem unless you simplify the methodology of analysis. Does this make sense? Stay with me. I'm coming, comrades. So I looked. Where is the pattern? I had a theory then, and I have a theory now. My theory was this: that all problems present with a patterned behavior and therefore a resolute finite solution. All problems. So if I spend sufficient time looking for the pattern and understanding how that pattern manifests itself, the behavior, I will have some indication of what the finite solution should be. Arc back to where we started. I understood the quantitative measures of business, and I tried to understand the determinants for success. And then I realized something. I realized that of those that succeeded, they had one thing in common. When I realized this, the entire game changed for me. Because even how I started analyzing businesses for potential opportunity, even how I started analyzing businesses that we might invest in, I started analyzing a different set of things. In my world, the world of venture capital, when you invest in a business, there are a number of things you're taught to look at. TAM, total addressable market. You look at the team and the founder. Do they have a technical background in doing the thing that they want to do? You look at the category, whether or not the category is growing. You look at the capital structure this business will need, the number of funding cycles this business will go through. And each time I looked at these, I understood that all of these were simple models of analysis, but they themselves were not the determinant of what would drive success. That even if you found a great team in a good market, growing market economics, fantastic unit economics, an amazing operator, and good capital, even then, there was still the possibility of failure. So let's just domicile ourselves a minute in what I've just said here. I've just said the following to you. I've said we're all here taught to analyze at the quantitative measure. The quantitative measure is easy because you can quantify it. To the operators in the room, I imagine you know what you made last month, revenue. Depending on the accounting system, you should probably know what's sitting in your inventory. You know what gross margins you're generating, what net margins you're generating. If you're anything like me and you love playing around with corporate finance stuff, you might even know your net operating profit less adjusted taxes. You're tracking your EBITDA on a monthly basis. You've got a running organizational valuation model that tracks EBITDA relative to the multiple assumed in industry. Quantitative measures. Laggards, not lead indicators. And then I understood the social case. They need to get more people of color, more women, more people of disability into economic enterprise. Got it. But understood that even though there was a need for that, it was not a determinant of success. And then I went, well, let's have a look at how people in venture do it. These people that have backed companies like Microsoft, backed companies like NVIDIA, now one of the world's most valuable companies. I hold some NVIDIA stock. Let me tell you, I'm so happy you don't even understand. The stock's doubled in the past 18 months. 227 billion turnover now. What an incredible business. Less than a decade old. So, it's like, well, how do these people in venture analyze? And I used that framework. And then I looked for whether or not that framework was the determinant of success. Except there's a problem there. Just study venture economics. 10, 4, 1. That's how it works in venture. You do 10 investments. 6 will lose money, 4 will return your money. It's a 1-on-1 return in a 5 to 7 year cycle. 5, 1 plus 2. That's how it works. And of the 10, only 1 will give you the 10x. So everybody knows the meta, but you don't know the investors that invested in what was Facebook, then became Meta, the 9 other companies that failed. So just so we're clear, even though the framework of venture takes the bet, the framework of venture doesn't guarantee the bet. I'm a lousy gambler. I'm looking for the guarantee.